Well, welcome everybody to the third in our series of quarterly updates from the National Council of Real Estate Fiduciaries ODCE Index. We have more than 300 participants who've signed up to participate in today's program. So again, welcome, and I assume people continue to be joining us as time wears on. Anyway, I want to get started on time. Again, ODCE, as you know, has become the benchmark for so many of you who are turning into this webcast, and we thought it would be helpful to start producing a regularly scheduled quarterly update on what's going on with ODCE, including what's happening with property investment fundamentals at the fund and property level, and where the index is likely to be headed based on what those fundamentals appear to be trending, as well as what the cues look like, all of the issues that most of you would be concerned about. Now, we welcome questions throughout the presentation, so to post a question, use the Q&A feature down at the bottom of your screen. Just click on the icon at the bottom of your screen, type in your question. Now, we may not be able to get to all of your questions, and any we miss, we'll try to answer in a follow-up email sent to all the participants after the webinar. As always, our presenter for these webcasts is Garrett Zdolshek, who spent the first 10 years of his career working as a senior consultant for Cortland, which is now a part of Stepstone. Garrett was one of 3 members of Cortland's investment committee and was involved in approving all client recommendations and consulting-related decisions. He also has been a member of NACRE for his entire career, and for many years has served and continues to serve as a member of our editorial advisory boards for our publications. For the past 6 years, he's been a member of the leadership team at IDR, and as the senior portfolio manager of IDR's programs, he's invested in virtually every ODCE fund. So obviously, this is a guy who needs to be an expert on ODCE and of what's going on in the ODCE universe. In fact, ODCE is all he focuses on. So he's eminently qualified to talk about this topic. We should note again that our plan is to produce a video presentation which we'll post to our 2 websites so that those of you who aren't all that familiar with ODCE can use that video as a primer to fully understand what the index is all about. We just haven't been able to get to it yet, but we will, so stay tuned. Meanwhile, allow me to introduce you all to Garrett, who's going to lead our program today. Garrett, thanks for joining us.
Hey, Jeff. Great to be with you as always, and thanks for having me again. So, maybe we'll just jump right into it, Jeff. And, I think, as you mentioned, we love questions. After these sessions, I generally get more questions. But what I'd really love is to get questions in advance, because we will hit on topics, throughout the quarter. If you want to ping any of us with things you want to hear about going forward, please ask. Always love topics, always love to do the research. So, without further ado, I'll kind of jump right into our agenda. I think as usual, we'll cover kind of 3 main areas. The first, the index at a high level, just the key, what's changed, what hasn't changed, real quick. And then I think we'll jump right into the fundamentals. Kind of, as I mentioned, given how many questions we got last time, and how detailed those questions were, we're really going to dig into the property type performance. And this is going to be pretty data heavy. So, please, give us feedback on what you like, what you don't like, but we're going to spend a lot of time on the data and the returns and where they're coming from, and in the valuations, because I know that was a big topic last time. I think as we go through this, one of the big things we're going to all see is based on how much income there is out of core real estate. It's really remarkable how much it can kind of offset or mask the actual appreciation, depreciation component of the index. So we'll kind of pull that apart, and then we'll end with the capital flows as usual, cues, money coming in and out of the market, and kind of what we see going forward. So with that, I'll kind of jump right into to the ODCE market update. What's changed? So very high level here, again, just start, not a lot changed for the quarter in terms of the high level metrics, except for 1 fund was added to the index. So we're now up to 27 funds in ODCE. Index continues to grow, which I think is great. In terms of property type diversification, not a big change largely except for office. And the change was really the result of sales, not acquisitions by the other sectors. So some bigger office assets were sold. We'll talk about that in values some more. But that also just kind of moved the geographic diversification. That office was largely in the East Coast. So pushed up the West Coast and down the East Coast, especially. Maybe jumping forward, we'll go right into the returns. So overall, ODCE for the quarter, I think was a bit of a surprise to some. Maybe it was a pretty strong quarter, just over 2%. These are gross returns. About half of that is obviously income. And, if you think about what that implies going forward, I'll pose the question. We can talk more about it. But, this first quarter implies an 8% annualized return, for 2021. The question we get a lot is, what will we see out of 2021? So we'll talk more about that. But we're really coming out of the cycle. So this is the first quarter. We feel like we've seen some stabilization across property types and across valuations. In previous cycles, I know I've showed this chart before, but I like to kind of keep it all relative and talk about this COVID cycle versus others. In previous cycles, we've seen some really strong returns coming out of these recoveries. I don't know that we're necessarily saying we expect double-digit returns again. We didn't see the downturn quite as severely as we saw the last time around. But I do think, ODCE could be primed for a little higher return than some expect going forward. But we'll see. There's a lot of kind of cross currents as well that we'll talk about. So valuation, I mentioned, we'll jump kind of into the details. High level quarterly returns in terms of quarterly appreciation only. So this is just the increase or decrease in value on a levered basis. So total appreciation number, you can see we really only had 3 quarters of negative appreciation during the cycle. And really only one of those led to a negative total return, so 2Q. But we're really kind of coming out of the cycle and back to kind of pre-pandemic average appreciation returns, that we saw kind of end of 2018 and before. So it does feel like things have stabilized a bit. Values seem to have found kind of their equilibrium at this point. But, again, it's a little property type specific. So we'll jump right into the properties. So last time I showed this, I thought we'd keep this going in terms of the peak to current valuation. And industrial and office are really pre-pandemic. We just viewed that as the peak. Industrial did not go down because of COVID. It actually went up. But here's the kind of peak to current values. You can see, obviously, retail took the brunt of it. I think the important thing to remember here is these are all unlevered returns. This is when we drill down into the property level because of portfolio leverage and other things. We really have to do it on an unlevered basis. So retail, for example, is really, more like a 25% plus type of negative return when you think about it on a levered basis. Kind of same for office, 5% plus negative return, on a levered basis if you imply some leverage. In terms of the quarter or year to date, 1Q, you can see it really kind of flattened out. Even industrial kind of came down a little bit, but overall retail was only down 1% now. That implies to us, some value equilibrium has been created. Office slightly down, apartment slightly up, and then of course other and industrial kind of leading the way. So values do feel like they've kind of bottomed in our opinion. We'll see how it plays out. It's certainly going to be asset by asset, but bit of a flattening at least.
Garrett, let me interrupt for just a second. I know some people joined us late and they may not have heard. If you want to pose a question to Garrett during the presentation, there's a Q&A icon down at the bottom of your screen. Just click on that, post your question. I will pose it to Garrett and you'll get your question answered. So feel free to post questions as we go along. If you see something that stimulates a thought in your brain, something you want to ask, feel free to do that. We want to make this as interactive as we can. Thanks. Go ahead, Garrett. Sorry.
Thanks. No, absolutely. Otherwise, you got to just keep hearing me talk about slides. So please ask. In terms of jumping in, retail is obviously the big big topic of conversation in terms of values, probably followed by office. But here you can kind of see the total kind of peak, if you will, to trough cycle. It's different for each property type, obviously. Retail actually really started the value decline pre-COVID. So 1Q of 2018 was actually the last positive appreciation number we saw out of retail. And you can see since then, it really got, kind of built momentum and exasperated through COVID, peaking in the second quarter of 2020, after the pandemic. And then now, appears to be kind of coming back and flattening out again. For the other asset classes, they were all positive return right up through the first quarter of 2020. So the peak, I saw the question a bit, was, where were the peaks? Really, the other asset classes really peaked, just right before COVID.
Okay. Also, somebody had asked, Garrett, Jerry Aversano, what property type do you expect to have the least volatility in income flows, cash flows over the next 3 years? Multi-industrial or something else?
That's a great question. I tell you, actually, I think what will have the least volatility is whatever has the longer lease. So I think you probably find some of the longest leases in office, but I wouldn't say office as a whole will be the least volatile. So I think it's a really great question. It's going to be really idiosyncratic in terms of what the lease structures look like. In apartment, I think a lot of people are surprised when we looked at the data for first quarter. Over the last year, in terms of portfolio performance, apartments and office were mixed, meaning some apartment portfolios performed better than some office portfolios, and vice versa. So it seems like, apartment is such a clear winner, in terms of overall performance and cash flows and income and stability. But if you had some of these high-rise apartments in these major metros, especially East West Coast, they had a fair amount of volatility. I would say probably if I had to pick one sector, I would tell you, I actually think garden apartments are probably going to be the most stable because, they just tend to be a little more diversified. Industrial, look, I think there could be a lot of upside, but, values are getting high. There's a lot of competition in the space, and you start to worry about, values getting bid up too high to be unsustainable. So, I really think it just depends on kind of asset by asset and what you're thinking about.
Now, Paul Chapman asked, how much of the decline in the percentage of office and retail and the composition of the ODCE Index can be attributed to valuation declines as compared to net sales activity?
So to make sure I understand the question, how much of how much of the value decline has been realized, in other words, probably versus just,
I think he's talking about
unrealized.
I think he's talking about compositional. So the decline in the overall relative value in office, how much of that was result of writing down the asset, or how much of it was result for net sell-off of those assets?
So yeah, that's a great question. I mean, we can do the math, but what I would say is, I think it's largely the value decline, or the percentage decline in office has largely been from either sales or buying of other asset classes or other property types. If you look at total office value change, it hasn't been all that significant of, peak to trough of 3%. So unlevered. So I would say the vast majority of it has actually been probably buying more of the other asset classes and some selling.
So Clayton Camper asked, thoughts of where the other sector weight will go in ODCE over the next 5 years? It's been growing pretty rapidly. Do you think that's going to continue? And what's driving that?
Yeah, sure. So I think that's a great question. I'll go back to the slide. We are kind of seeing a consistently steady increase in other, we're at about 5% today. I think NCREIF is looking at a couple things. One is, more precisely defining some of these assets and property types. So, for example, life science can be found in office and other, depending on classification. About half of other is self-storage. So does that really deserve its own property type like hotel did at one point? So I think, as a whole, other will go up to 7-8%, probably in the relatively near term. But at the same time, I think it also is a bit of a reclassification, that could easily move that number pretty quickly there, with life science and, even, I'll say single family rental, for example, is that apartment? is that kind of the housing, apartment classification or other? So a little bit of it is really how you'd classify it as well.
Now, somebody also asked, Adriana Del Alcantara said, do you expect malls will drive returns further?
Do I expect malls will drag returns further? I think some will, and I think some are recovering nicely. So, I think overall, if you, and I'll talk about this in a minute, in the public markets, but if you believe the public markets, it would tell you we've largely bottomed, and they won't. If you look at some of the fundamentals, and I'll talk about NOIs as well, you might have a bigger question mark on that. So I think it's very asset specific, but by and large, I think a lot of the ODCE malls are pretty high quality, and they're stabilizing as the numbers would tell you they are.
Okay, thanks.
Sure. Maybe I'll kind of jump right into that, because I will get into that a little more in terms of property type returns and kind of where we see things going. I thought one of the interesting ways to do that would be to kind of look at the public markets. I got beat up pretty good on here, a few quarters ago, talking about these REITs being down so heavily. What's wrong with the ODCE valuation? So I couldn't help myself but bring it up this time around. And look, I think first and foremost, this is all point in time views. So I don't get overly, exercised when I see the REITs down significantly, and I don't get overly exercised when I see them up significantly, because I do think they have different exposures, different types of assets, different structures that all lead to a little different outcomes, at a point in time. So but I couldn't help myself but put this chart up here to show you basically, if you look at this, the chart's index to 100, REITs as of the first quarter ended up almost exactly where ODCE did on a total return standpoint, at the end of March. So, digging into that a little further,
before you leave that slide, Garrett,
yeah.
Do you think, and this is just a personal opinion, but do you think the volatility of the REIT market accurately reflects the volatility of the underlying property market, or do you think it's amplified because of public market swings?
Oh, I think it's absolutely amplified by public market swings, right? I mean, it's the function of liquidity and ability to sell at any moment, on any news and vice versa. So I think a good part of it is public market volatility. I think there are different exposures and different types of assets in both. So I don't think they should, act exactly the same anyways in terms of a valuation standpoint. But I think they'd be closer, if you made one, have the same structure as the other. But, REITs have, I think, about 35% leverage today. That's even going to have a, bit of an impact.
Yeah. So the true volatility probably lies somewhere between NCREIF, ODCE, and the REIT market, right? In terms of underlying property value fluctuations.
Well, I think, yeah. Look, I think they both are what they are. Transactions happen at each of these valuations. So, I don't get too caught up in what's the true real estate value, as long as they're transactable markets and, money is exchanging at these values. I think they just are what they are. And I think depending on your portfolio needs and liquidity requirements and a whole host of other things, time frame of investment outlook, one can be better for you than the other, and sometimes both is great for you.
Okay.
So kind of coming back to this total return by property type, year in review, if you will. We kind of covered this. Annual returns from 2020 as a reminder. Again, this is ODCE property type unlevered returns. So you see, retail, versus industrial for 2020, and kind of apartments and office in the middle. Going into 2021 here for the first quarter, you can see, total return, retail was pretty flat, income offset depreciation, office, apartments, and industrial are positive, with industrial, continuing to lead the way by a significant margin. And I think, pay attention to retail specifically here on this return, and, wanted to kind of talk about REITs a little bit in that context. They were obviously down much more significantly, in 2020, with the exception of industrial. But what I think, you really saw in that previous chart was this recovery. And through the first quarter, industrial was actually starting to, lag a bit, some of the harder hit sectors, especially apartments and retail. What I thought was interesting was office and industrial kind of stayed, about the same. But if you fast forward even more to a year-to-date number, not just first quarter, really through kind of the end of May, retail was up even more significantly, and again is the best performing sector year to date. But that's off a really low bottom, obviously, compared to the other asset classes. So to kind of come back to that question about retail, it's actually leading, kind of the best performing sector, right now in the REIT area. I don't know that I'm prepared to say I think that's going to follow suit in ODCE by any means, but I do think it at least kind of foreshadows maybe a bit of the kind of bottoming of values.
Okay.
Anecdotally, we're hearing, especially on the grocery anchored side of things, the yields are becoming so compelling that especially private capital, like family office type of money, is buying pretty actively again, just for the yield, and is pretty comfortable in owning those types of assets again.
Okay.
Last section, and again, I think we may not always go through as much detail on the property type returns, but that dispersion that we've been talking about between best performing sector and worst remains really elevated, just off all-time highs. So it's, it came in slightly, but not much. And again, I think we're just going to kind of continue to watch this, pretty closely to see, if this dispersion continues or if things start reverting to the mean on both ends a little bit or not.
Okay, again, people, if you have questions, make sure you submit them. Can't ask them if they aren't posed. So use the Q&A at the bottom icon to post your questions. Go ahead.
I think this just means I'm being really thorough. So before we delve into a little bit of the capital markets, I'll just touch on property type NOI. In past reviews, we've talked about rent collections. Those have really stabilized, so I didn't see a need to throw that chart up again. But we did see, in a way, a bit of a furthering decline in NOI, just because a stronger quarter kind of rolled off and a weaker quarter rolled on. I think this is absolutely the bottom of that kind of NOI decline. And again, looking at property types, I think it's pretty self-evident why retail did what it did. What I mentioned earlier was a little surprising is really how much apartments kind of suffered in that NOI cycle, but are not being revalued, because I think the market sentiment or view is that will recover, pretty rapidly once the cities are open again. And this was really driven largely by the high-rise apartment sector. So it is kind of interesting, I think, how that fundamentals aren't necessarily always lining up with the valuations. Certainly industrial, I think, is justified really strong NOI at 5%. But again, the historically looking, the office market is still seeing positive NOI growth. But obviously the market view and the future expectations of that are not good. So that has affected office values, and I'll talk about transactions, but again, I think we are seeing some equilibrium in values at least. I showed this chart again last time around, and I thought it was worth talking about again. I won't go into the details on history again, but real estate has generally followed the spread to treasuries or followed capital markets overall. And when you look at kind of where we are, historically, last quarter I showed this chart, you could see kind of that big spread. And the question was, does the blue line come down further, the gray line go up? How do we get back to kind of average? And I think it does make sense to see that blue line coming down. So it has come down a fair amount, but we're still well above historical spreads. And, depending on outlook, it's going to be interesting, because I think there's probably more pressure on that blue line to come down. You think of core real estate as, the big income producing sector, but also maybe an inflation hedge, and maybe inflation is starting to to be a real topic again. So I went back to some of our old research and wanted to look at, what were kind of the periods of either rising rate or rising CPI. So here, are in effect rising rate periods. The Fed obviously seems pretty content to leave rates lower for longer, but I would also argue they're not always right on the timing of that. So sometimes rising rates precede inflation, sometimes inflation precedes rate. It seems like the Fed wants to purposely be late than early. And if you look at average returns, they've been really pretty compelling against the other, 60-40 portfolios of stocks and bonds. So, we definitely are feeling, I think, the capital flows increased to the space, partly because of this. And also partly because of that CPI number. Everyone you talk to, I think, feels costs are going up one way or another, whether it's building costs, asset costs, or just grocery costs. So, we also wanted to look at average return of core. This is quarterly average return during rising CPI periods, and how that's kind of, related to the public REIT market, at least. And they're both, fairly attractive, certainly, because they're both hard asset based, but I think the private assets have probably benefited a little more than is appreciated.
Okay, I'm getting a bunch of questions coming in, so I want to give a chance to answer them. You seem to be anticipating one of them, which was, if not today, at another time, would you take a look at the indices, ODCE, NFI, REITs, vis-a-vis inflation and interest rates? You didn't completely do that, but you did part of that. I should note that we've got a podcast scheduled coming up in a few weeks with Dr. Randall Zisler, who is our director of research for our company, and Ethan Penner of Mosaic, former Wall Streeter, who headed up Nomura's operations in the 90s during the heyday of CMBS. So both of them have some very interesting things to say about inflation. And there's a lot of conjecture that's going on about what we can expect looking forward to inflation, and they'll address those issues in that particular webinar. Now, Brian Bode asked, with property levels NOI down 7% in first quarter, what like-for-like valuation metric increased property appreciation by more than 1%? For example, cap rates decreased 30 basis points, etc. What happened here? What's going on here? Is there a disconnect, or is it something else going on that we're not looking at?
Well, no. So yeah, that's a great question. I think what I skipped over was the cost side. So while the NOI side was definitely down, I think managers have done a great job kind of managing their cost side of the balance sheet as well through the cycle. So costs have been down almost proportionately, depending on, again, portfolios and some other things, but really reduce costs to save some capital during this cycle. And, I think also interest rates, have gone down significantly as well. So, while it's not a huge percentage of the cost side, interest rates, payments have gone down as well in the assets. So it's not a one-for-one value to NOI. But I do think on the other side, the reason I kind of want to show it is I do think it leads to more upside surprise than downside. I think we've seen the worst of the downside there. And certainly some more money is going to have to get spent. The longer you defer it, the more you spend. But I think that will lead to some upside as these rents. One, some deferred rent will be collected, so that's not going to be in the underwriting. And then two, kind of getting back to pre-pandemic rates will, I think, likely, give some upside on the income perspective.
Okay, we have another question in from Ali CD, who says, in those higher inflationary periods, where were the returns most impacted, appreciation or income? In other words, were the income rising faster, or was the depreciation rising faster as a result of?
Yeah, that's an interesting question. We can look at. I'd be interested to look at that because I think the other piece of that, right, is the appreciation's going up because you expect the income to go up. So it's kind of which one's driving which would be kind of an interesting kind of comparison. I'm looking at Brian. He's our head of analytics. That sounds like a great project.
Yeah, be a good research project for sure.
Yeah.
Okay.
All right, maybe I'll jump right back into what I think everyone really wants me to get into, which is capital flows. So going back to capital flows, and I think I'm sharing my screen correctly, right, Jeff?
Yeah, no, it's fine. I can see it. You've got your transaction summary right up there right now.
Perfect. So overall, total dispositions were about 4.7 billion for the quarter. There were 75 in total, or 74 in total. I think of note what was interesting, there were 5 CBD office assets over 250 million a piece that were sold. And those were largely sold at or above book value. So, rightly or wrongly, and there are obviously 5 assets. I'm not making a broad statement on this because I do think, depends on the asset, but there were some pretty big assets that were sold at value or above value. So I think that's at least positive. And then, there was one industrial transaction, but it was really just a portfolio transaction as part of a sale. So, fairly quiet and kind of as expected, I think, in terms of asset dispositions. Total acquisitions, there were still about 2.5 billion of acquisitions for the quarter, 29 deals in total, 19 industrial, and about 20% of that value is in development and leasing strategies. So, obviously people I think are rightfully so, probably willing to take some risk, and try to create some value still in that industrial sector, but definitely taking some risk to do it. With development and, again, it's all, is it pre-leased or not, those kind of things. But, then we saw a little bit of storage, interestingly manufactured housing, deal, and then some mezzanine loan, actually one mezzanine loan deal. So, again, fairly well-rounded as you would expect, I think, based on, the attractiveness of the property types or not.
Now, somebody had asked, can you get granular when you're looking at the apartment sector? Are people buying garden and selling off CBD, high rise, or vice versa, or do you not have that data?
We can get granular. I would tell you, it's more suburban, garden at this point. I think the high rise is a bit as mentioned, rents are down but values are not, so you're almost buying those at pre-pandemic pricing, whether it's right or wrong. I think is up, remains to be seen, but you're really not getting a discount for the decline in NOI on the apartment side.
And Paul Chapman asked, if ODCE managers are selling office, can you generalize on who the buyers are? I mean, looks like the ODCE managers are trying to lighten up in the office sector, but somebody's taking advantage of that. But they're not buying a discount. Who are the buyers? Do we know?
Great question. We don't really look at the buyers. Once they're out of the index, I don't care.
Yeah. All right.
No, honestly, we just don't. We don't see that, the buyers. But that is an interesting question. Who
yeah, maybe that's something that somebody on the research side could answer down the road. Who does track, the CoStar data and things of that nature? If you know what properties are in index, then you can cross-reference it.
Yeah.
Like Clayton Camper asks, any sense that the office sales coming in at value is because people are selling the office they can sell, as opposed to what they would like to sell, in an effort to reduce office exposure and reduce outbound queues?
Yeah, I mean, that's what I was kind of, so look, I was kind of referencing that's the $1 million question, right? I mean, I'm sure no matter what manager portfolio you look at, there are certain assets that are going to be less attractive and more attractive. And that's all a function of a host of things, including where you are in their business cycle, where you are with leasing, all kinds of things. So, I wasn't trying to get overly, excited about it, but I also wasn't, trying to sound too pessimistic about it, because, there are assets trading at value, and I'm sure there's some, that could be more challenging than others. So, I think it comes down to lease term, credit, a whole host of things. But these were some pretty big transactions that I do think, at least, for now, are a pretty good view of where certain assets can trade at least.
Okay.
And again, kind of coming back to the overall cash flow picture, certainly more sales than acquisitions, as I talked about, and that kind of flows through to the investor base. And you kind of see on the far right here that the blue is contributions from investors, the gray is redemptions or payouts, and this is all kind of total. So whether it be reinvesting of income or new commitments, it's just total cash flows available for investment. And then on the gray side, it's total cash flows that have to go out to investors. Certainly still a negative, total kind of outflow of about $2 billion. But at the same time, I thought it was pretty positive. This is, sign of a healthy market coming back, and that you have pretty substantial inflow and outflow. I think you have investors repositioning their picks and their managers right now. I think you have funds repositioning their portfolios. But overall, I think it's great to see some, positive progress on both ends.
How about, are you going to talk about Qs in a minute?
I'm ready. So, and as a reminder, just given some of the confidentiality and given some of the masking requirements, we take pretty seriously. What this is these are Qs that started post-COVID. So Qs that came into the market starting in 2Q 2020. This isn't necessarily Qs that were already there before COVID, okay? But what we wanted to really look at and report on is how has the COVID market impacted, Qs, incoming, outgoing, and certainly the redemption queues are still the main topic of conversation. I think what's interesting is, you see we did peak, in 3Q there at about 6% of NAV. It's come down to about 4%. But remember, this isn't static. So each of these quarters, more redemption, theoretically can and has come into funds, while they're also paying out quarters. So what's interesting is, they're still making progress on getting these queues down. I think the new redemptions coming in have dramatically scaled back. But you do see a little bit of rebalancing and a little bit of, investor kind of repositioning now that things have opened up a little bit. The other thing is, though, that the entry queues are starting to build on the other side. We've seen this in all cycles where, there is a period of time generally where you have conflicting views, you have conflicting values and thoughts from investors and funds. So, about 4%, about half of this 4% is actually sitting in commitment queues. It's not always even though. So some funds might have just an investment queue while others have a redemption queue. But a number of them have a bit of both as they kind of manage, their cash flows and capital calls. But I think net moral of the story is we are seeing funds make good progress on paying out their redemption queues. I think they're going to continue to do that through this year, some much sooner than others, obviously. But I think they're meeting redemption requests and also bringing in new money now as people get more comfortable with values. So I wouldn't be surprised if, we start having more conversations about how long is it going to take to get my money out than when am I going to get my money out? Because, we are seeing the flow build. I kind of mentioned, the kind of fundamentals in the capital markets, but we do think, the returns are kind of primed to recover here a fair bit. So with that, Jeff, usually each quarter, I think, well, I guess we have one question, right? Is there a significant delta in the average AUM of the ODCE funds receiving significant redemptions and contributions? So I guess the question is no. So I think the question is asking like, are all the small funds getting contributions and all the big funds getting redemptions or something like that? And the answer is,
we know, there've been some talk about some. I know we don't like to get personal and talk about individual funds, but people do talk about individual funds amongst themselves. And the question is, are they skewing the results in some way? The funds that have large redemption queues, or is it pretty evenly spread across the funds?
So in these numbers, it's not being skewed because again, we're just talking about post-COVID and we're talking about percentages, a market. So that is not skewing the numbers. But I will say what we are seeing is, across the board, we see some big funds with entry queues, some with redemption queues. Same thing on the other side. We see some small funds with redemption queues and some with entry queues. So it's a very case by case basis. And I think it's very performance related.
James Freeman says, apologies if I missed this, but will this presentation be made available to participants? If you registered for the for the seminar, for the webinar, yes, you'll be given a link to the recording of it and be able to view it. But if you didn't sign up for it, you won't have access to it. That's the answer. Victor Del Piso, hello, Victor. Nice to hear from you. If you have data on historical size of queues, how does the current level of redemption queues compare to historical average?
Yeah, so we do, and during the GFC, we saw a peak of about 13%, I believe, of redemption queue outstanding. And that kind of built up and went down, in a pyramid a bit like this too. But the peak was, about 13%.
Okay.
And that went from 13% trying to get out to 13% trying to get in a pretty short, period of time in 2010.
And Paul Chapman says, Garrett, it would be interesting next quarter to see slide 21 queues on a net basis, redemptions offset by contributions here. So something we can do next time, okay?
Yeah, absolutely.
Great. Any other questions coming in, or we're getting close to closing down this particular webinar? Going once?
The last question, Jeff, I guess is, maybe we'll end it on this, outlook for performance for 2021, kind of what we see for the year. And I would say, our kind of net outlook, I think again, not trying to be too precise and not trying to be too, confrontational, if you will. But I would say we kind of view it as a 7% total net return for the year, with, I think, more surprise on the upside than the downside. So I think you could be surprised on higher returns. And, I think, as we look at it, it kind of comes down to the three things. One, relative kind of asset class comparison. We see a fair amount of capital coming to private real estate from the 60-40 portfolio, if you will. Stocks and bond outlook is pretty grim at the moment in terms of return expectations. So definitely seeing more investors come to real estate with a bigger allocation, or for the first time, because they just can't get there otherwise with their outlook, total expectations. Second, inflation certainly has people talking about harder assets again, and real estate in particular. I think there was a horrible article in the Wall Street Journal about inflation, and you just don't know what you're going to get out of real estate. You might have rising rates or rising leases, and you might not. I think that's pretty obvious to the real estate people, but it really depends on the asset class you're buying. And then I think, thirdly, the income component, again, just the income is strong. It persevered through the kind of COVID recession, if you will, and volatility remained low. So I think that's been highly attractive to investors, which all points to, more capital coming to this space overall.
Okay. Well, looking forward to the next session. Again, it'll be another quarter before we're ready to present again. But in the meantime, if you do have questions you would like Garrett to address, this can really meet your needs. You tell us what you want to hear about. You can either send those questions to me at g.dohrmann@irei.com, or you can send them to Garrett. Garrett, what's your email address?
GEZ@idrfof.com.
Okay. And if you didn't get that, send me an email and I'll send Garrett's address out to you. We've got a lot more now. We've got a lot more webinars coming up. We just completed one on our first IREI live webinar on life sciences, which I found illuminating. I didn't know much about it. Many other people had noted that it was very, very educational, so good. The next one that's coming up next week is a webinar on diversity, equity, and inclusion, which is a hot topic today. So be sure to tune in for that. And we're posting podcasts all the time, so check our website. Lots of good information, lots of good, interesting insights into what's going on out there in the markets. Thanks, everybody, for tuning in. Hope you did find it great. We got some nice positive strokes from some of you. Thank you for your comments, and thanks for posing your questions. This is your webinar, not ours. It's all for you. So continue to keep those questions coming, and we'll make this as relevant as we possibly can for you. Have a great day, everybody.